How does that, moving in or expanding the offering, how are you finding that within the wider infrastructure and how the general infrastructure is developing, especially obviously since, I have to bring it up, but post FTX and Binance more recently. What's your take on the infrastructure in general at the moment?
Right. So I think the wider digital asset industry, especially as it applies to trading infrastructure, is built on the hopes of a very advanced technological platform. But the reality is it's quite clunky still, better than traditional markets, but it's still not institutional grade, as everyone likes to call themselves. So what are the problems? These systems are very slow, so they take in the hundreds of milliseconds to place trades, which introduces a significant amount of slippage on prices. So if a client wants to execute at a certain price, they're getting filled at certain basis points higher that does not give them any advantage in the markets. In fact, it disadvantages them. So there's the execution, which is a big issue on the speed. And that applies to not just high frequency traders, but also any type of trader, really, even long only traders, because any price they need, they won't get the best of. So there's the latency issue, then there's a privacy component. So a lot of the infrastructure that's currently built routes through the servers of those service providers who are facilitating that service. So many current execution providers will have trades going through their servers, which they're able to see the full data and IP behind the trades that are being done, and that introduces significant front-running risk. So if you're a competitor execution provider and you see this flow coming through, you can easily delay the trade and place trades ahead of them in order to get advantageous placement. So that is a big risk that a lot of funds are not totally comfortable with, but they don't really have an option right now unless they go and build it in-house. So we've seen the rise of in popularity of the decision for many high-quality institutions in the digital asset space build in-house. And that comes at a large cost because it's expensive, it takes a lot of time, and you don't have a service provider agreement being there to support you. That's why in traditional markets you have all these funds outsourcing their tech to different components. So you have the execution being one provider, you have the risk management being done by another provider, you have the portfolio management, the data, all these different components that are segregated as it should be, because it's really hard to build a good platform all by yourself. So the privacy element is a really big comfortability factor, which we've been able to provide. So clients, their entire application is on their own servers, and we just provide that infrastructure and connectivity so they can get best execution and direct market access quickly. Now, the third component, other than the execution and the privacy, is on the pricing side. So with current execution providers, and even when you factor in custody and exchange fees and prime fees, it's hard to generate any sort of alpha when those clients are paying between 1 and 5 basis points probably per trade before they even make the trade. And that's quite costly, especially when you're trading intraday, but even when you're trading tens of millions of dollars or even in the billions, it's a really big hit to that trading strategy that's aiming to trade. So on the execution side, we don't really believe in charging based on volume. Instead, it's all fixed as it should be, which allows the client to focus on their trading and not focus on trying to avoid fees or making a minimum amount of alpha just to break even, because technically they're in the hole before they even start the trade, which is not conducive to any type of trading strategy. I mean, you've probably seen this from clients on like the cap intro side. Like they display a bunch of these strategies that are back tested, but the strategies that are being back tested aren't taking real live fees in consideration. And there's also market impact, which is a huge component. So we're aiming to eliminate that burden on clients so they have the best execution, they have the privacy, and they have the favorable fee structure to facilitate all of this.
Well, okay. There's some serious thoughts going into this. Yeah, there's never a bad back test, right? You don't take into account enough. It's always a lovely straight line and perfect performance. Coming from the CTO world, I know that one quite well.